Okay, we'll start. Yeah. You had your lunch? That's good. You were late for the morning, right? You had have enough sleeping yesterday. That's why you got up late. Okay. So are there any performance? So what happened to your friend? They literally go other girls. Touching you to make sense. Charlie, you must say. So we'll go to the next one. Differential growth. You can take down the heading differential growth. Differential growth, right? Online student, hope you all can hear me. We have started the second session and then starting with the differential growth rate. As name implies, right? We have studied about the zero growth and then constant and then moving towards the 2.3 differential growth rate, right? So here, we'll take down, we'll identify the concepts by our example. You can see here, year 0 to nth year, right? Nth year, there are some 1, 2, 3, 4, 5, and 7. Likewise, there are some years. During these years, right, there are two stages, right? Two stages are there, starting from year 1, to year 6, right? So dividends are, just we'll identify T0, just pay dividend is 5 rupees. And then the particular company express our dividends. Our dividends will grow from first year to the 6th year with the growth rate of 15%. And then even the example does not include. So our dividends here D1 to D6. 1 to first year to the 6th year. Starting from 6, right? D7 to D8. That means starting from 7th year to 8th year. Right? So growth dividends are growing at 10%. 10%. That means from here to here, right? Growth rate, we don't know since this is the first one, we mark it as a G1 and then this is G2, that is 10%. Then after what happened? After the 8th year until the nth year. That means long run, right? Or it might be in long run, it might be until the infinity. Dividends are, that means D8 to Dn. We don't know that time period. Our dividends will be growing at G3, growing at, starting from 60. Starting from 8th year to nth year. Nth year, our dividend will be growing at 5%. How many stages are there? How many? 2 or 3? Let's look at this one. How many? Red color one? 3 stages, right? Year 1 to year 6. First stage. Year 6 to year 8. Second stage. Year 8 to end stage, right? Third stage. How many growth rates? 3 different growth rates. How many? 3 different. What are the 3 different growth rates? Exactly. Right? J1, 15. Growth rate, 2, 10. Third growth rate, how much is it? 5. Now you can identify differential growth rates, right? Different growth rate, right? So this is called as what? There might be some scenarios like this. Some shares will offer the differential growth rate, right? They are not giving, okay, your dividend is not only constant, right? Your dividends are not always constant, as we lectured in the first and second subsections. First section that was discussed about the zero, and then second stage that was constant. Differential growth means having different growth rates. Having different growth rate. So, but for your syllabus, we are just considering 2 stages. There might be more than this one also, right? There might be 10-stage models. Can't it happen? No, there might be some practical scenarios, right? Year 1 to year 2, another rate. Year 2 to year 5, another rate. Year 5 to 6, another dividend growth rate. 6 onward, another growth rate. There might be some cases like that. So what do you call this? This is the differential growth rate. Differential growth rate. Are you clear on this one? Good. So if there are some differential growth rates for your syllabus, again, we are discussing about 2 stages. Stage number 1, we consider this is the stage number 1. Whatever the year, year 6, it might be 6, it might be 7 or 8, 9 or whatever the year, we don't know. So this is the stage number 1. Stage number 1, and then in there, growth rate equals, we name the growth rate as growth rate 1. Then second stage, so we consider dividend will be constant, right? Constant. For your syllabus, we take the first one as a dividend growth model, and then dividends are growing at a particular growth rate, and then second stage. In the second stage, dividend will be growing at a constant growth rate. Constant growth rate until infinity. Infinity or long run. This is called as growth rate. Growth rate 2. First stage, and then second stage, right? First stage, we consider dividends are growing at a particular growth rate, and then second stage, we consider dividends are growing at a constant rate. That is what we have lectured in 2.1. it should be 2.2. 2.2. Are you clear on this process? Right. Then with that basic knowledge, we'll identify the way of calculating the price regarding this particular share. Help me. Tell me the way of calculating the price regarding this scenario. Dividend in first year, dividend in second year, D3, D4, D5, D6. How can we take the value in this first stage? We know this is the stage number 1. Stage number 1. How can we take the value? Dividend. Dividend. Exactly. What is it? Present value of PV of all dividends. Present value of all dividends. Are you clear how we can take the present value of all dividend? How can we take? How can we take D1 divided by 1 plus R to the power n should be 1. Is that all? No. Have to calculate D2 divided by 1 plus R to the power 2. And likewise until the whatever the end of, this is called we as the end of first stage. So then you have to consider present value of all dividends until the end of first stage. First stage. You have to identify the rationale behind this. Then that is done. That's done. Right? It is simple. The second one, right? Second one, that is something technically you have to understand. So this is now stage number 2, constant model. Constant model for constant growth rate. Constant growth rate. If it is a constant growth rate, do we know to calculate the value at that constant model? Yes, we know. How can we? We previously calculated. How can we? Dividend in which year? Dividend in first year divided by difference between R and growth rate. Now here what growth rate you have to consider? What growth rate you have to consider? Growth rate 2. C2. This is the growth rate. Now important thing. Can we find D1 here? D1 here? No. So then what should we have to take there? Very good. What is it? Every dividend is close to constant. Equal. Constant, do we have a equal dividend? No, we don't have. By constant model, we consider the D1. How can we take the D1? D0 multiplied by 1 plus growth rate to the power 1. So then in the constant model, dividends are not constant. But 0 model, that's constant. This is another model. Right? Where we are starting this model? Here 6. So then D0 is what? D0 is the end of the first stage, right? And then you are starting, I'm at here, right? My current year is now T6. So then what you need to consider? Next year dividend, right? That means next year dividend for which year? To the second stage, right? Second stage. So then if you want, you can write it down D1 or else here it should be actually DIV 7. DIV 7. So what is the actual notation for this one? D7 means what? D7 for the first year dividend of second stage. This is second stage. Second stage, first year dividend. That is what you have to understand. Clear? This one. One thing done. Now we have taken the value. I am calculating the value at which date for the second stage? At the year 6. So then, if I am getting the value, if I am getting a number from this model, it is up to which date? It recorded. It gives us the value for which year? Again, right? Okay. I'm starting the second stage from the 6th year onward, right? So then I'm at the 6th year and then I have applied this model and calculated the value. Just imagine that value is 20. This 20 belongs to the, or else this 20 has been calculated at the end of the 6th year or else at the end of the year 0. Which year? At the end of the 6th year. I have started it there. So then if I take this 20 as well as this stage, present value of all the dividend payment will be cast at 15. 15 plus 20, is that correct? No, that's not correct. Because why? I have taken the second stage value at the end of the 6th year, which is after another 6 years. That has to be converted to again then to the present context. So then we have another formula. You have to multiply this answer. This is your second stage value. That value should be multiplied by 1 divided by 1 plus r to the power how many years? Exactly to the power method value 1, 2, 3, 4, 5, 6 to the power 6. Right? To the power 6. Clear? Okay, we'll go to the. Do you want to write this one? Can you please write it down first? Very clearly take the picture and then draw it in a separate space. Below this one, I will give another note. So therefore, write down, keep the space there. Well done. Okay. So now, next one. Now we'll go to the formula. So DN. We'll start from this. Huh? D. DN means we don't know at which year different models ended the first stage. Right? Therefore, you take the DN. That means year it might be year 6 or whatever the year. It should be growth with the 1 plus growth rate. This is, if you want, please write it, mark it as growth rate 2. GC means second stage growth rate. Otherwise, you can take it as a G2 also. And then difference between R and G2. R and G2. Multiplied by 1 divided by 1 plus R to the power n. N means actually here marking number of years in first stage. Number of years in first stage. This entire part, starting from here, this is reflect what? Value of share during or in second stage. Second stage. Value of share during the second stage. First stage. Start from year 1. Start from year 1. Until nth year, we don't know. Nth means here, end of the first stage. End of the first stage. Consider sum means total. Dividends, present value. Dividend means starting from D0 here, right? Each you have to identify D1, D2, D3, D4, and D5. That's all. Mathum, tell me how can we identify the dividend for the 5th year? We calculated that. How can we identify the D5? Yes. We have D0. How much is it? Not given. Just take it 6. D0 multiplied by 1 plus growth rate to the power. How many years, Patu? How many years? 6 years. How many years? And then how many years? 6. How many years? 5 years. You are at 5th year. 5th year. Can you take this value and add? Can you take the year 5 dividend and add to the value? No. What you need to do? Divide it by 1 plus r to the power. In our example, 1 plus r to the power 5. Even it is showing us a very easy one. There are 2 tasks. What those 2 tasks are? Taking the respective dividend, calculating the respective dividends, and then second one, converting those things into the present contents. And then take the total of that present balance. So this is one, right? Identifying dividends during respective years. Divided by 1 plus r to the power n means converting dividends to present contents to PV, converting dividends to the PV, and then take the sum of it, right? Take the sum of it. Take the summation as the stage number 1. Stage number 1. This shows starting from here. This is what? This is the stage number 1 value. Stage number 1 value. Or is the value bundle, value of share in first stage. Value of share in first stage. Both together, collectively, you have to consider what? Collectively, both as the value of the share. Clear? We can do example and have a proper understanding. Just if you want to write down something, please write it there. This is here. First year, second year. Okay, we'll go to the question. Right? We'll go to the question. All right. Example number 5. First, draw this one in a timeline. Answer, please.
Yeah.
Draw it in timeline first and mark it. We read the question. Take age forecasted the following growth rate of dividends. The company expects dividends to grow. The company expects dividends to grow at a rapid rate of how much? 50. Then mark it. What is this? This is growth rate 1, 15%. Until the end of 6th year. Yes, exactly. That means we have identified year per stage. How many years? 6 years in stage number 1. And then after this growth rate will stabilize in long run with a constant growth rate of how much? 8%. Just paid dividends. Just paid dividends are 3.48. But you ask required rate of return is R equals 18. Please calculate what? Present value of the common stock. So please draw this one first. Right? This is your mind map and then try to calculate the value. You first try to calculate the value. So then I will teach and I will correct your from points. Draw this one, and as we know, there are 3 stages. Try to calculate the value under these each stages. Oh, yes, yes, you yes, you don't can it. 1, 2, 6, 7, 8. Plus, total, what you are, 1.5, the brother, 1. So, they from the brother. What? They're going to make them do it. They didn't actually go plus. Rather than relay up in the year, 0 in the eye, the word plus. Okay. 0.3. Finally, divide by to the power how many years? Evidence first year के वजह ना करता evidence section की खाना ना करता इतना practice करना होगा इतना पास से मारने के लिए or 6. Yeah, for the 6 years, they will have each time 1, 2, 3, 4, 6, and 6, 7, 8. And then individual balances should be divided by 1 plus of the power 1, 2, 3, 4, 5. Yeah. Right. Please write it. Please identify stage number 1. Stage number 1. What is the stage number 1? Identifying value of share in first stage. First have to calculate the PV of dividends, or else PV of all dividends. PV of all dividends. We have D1 starting from D0, D1, D2, D3, D4, D5, D6. 3.48. D1 3.48 multiplied by 1 plus growth rate 0.15 to the power 1. That is not enough. Right? That is not enough. Have to deal with present value. So then divide it by, right? Divide that answer by 1 plus required rate of return to the power 1. Right? Then second one. $3.48 multiplied by 1 plus 0.15 to the power 2. Third year dividend 3.48 multiplied by 1 plus growth rate 0.15 to the power 3. 3.48 multiplied by to the power 4. 3.48 multiplied by 0.15 to the power 5. 3.48 multiplied by 0.15 to the power 6. Calculating the respective dividends in the respective years not enough. Therefore, convert those things to the present context. 0.18 to the power 2 divided by 0.18 to the power 3 divided by 1 plus 0.18 to the power 4 divided by 1 plus 0.18 to the power 5 divided by 0.18 to the power 6. Take the value from year 0, year 1 2 here 6, and then add those things and take the summation. That should be around 19 point something. Then stage number 2. I will just show you the flow. Stage number 2. Second stage. Right? So in the second stage, we have 2 steps. 2.1. Identifying the value. Identify the value under constant model. Constant model. How can we calculate dividend in which year? Dividend in which year? Dividend in 6th year multiplied by 1 plus growth rate. They take the answer 2.2. 2.2 converting constant model value to present. The calculated answer should be multiplied by 1 over 0.18 to the power 6. Discuss with your friends and try to do it. This is not the last step. You have to take then consider the step number 1 value and then the step number 2 value. Yeah. All this one point time. This one is how much? Around 90. That's plus. And then the thing is here. We have taken pieces of next row, right? It should be dividend table, which is the 6th year. Dividend table 6th year, not the present value. Right? So then that is 6. This is 1. It is 1. And then we have to get a problem construct work rate 2. You can write down that simple. The stage answer should be around 90. 190. We're going to 8 to the power 1 plus 1 to the power 7 to the that's the thing. You get to they very still in the middle. So thanks to the money they will go straight. Okay, we'll do it. Okay, tell me the answers first. Okay. D1, how much is present value? 2. Present value 2 point. Yeah, 2 point. D1. D1's present value. 3.39. And then second year 3.305. Third one 3.221. 3.221. Fourth 3.39. For fifth year 3.139. 139. Okay. Fourth year
3.059.
3.059. Sixth year
2.981.
2.981. All together 19.11 or 19.0. That part done. Question is this one. You are getting confused in this one. Again, I am telling that we have to start the second module from the year 6 onward. So then, this is what we are calculating. What is this? This is D7 actually indirectly you are calculating D7. But the thing is, you can't take D0 multiplied by 1.15 to the power 7. Why it is? Because in the second stage, growth rate is different. Right? So then calculate T6 first. This is your T6. This is your D6. How much is the value? D6. Don't take 2.981 as the D6 because why? That is the present value of the D6. We don't need present value. But we need the real value of the D6. So then take that D6. D6. So here, how much is it? How much is it? 8.01. 1, 5. Multiplied by
8.0.
1, 0. 8.05. Multiplied by 1 plus growth rate 0.08. This answer should be divided by R is 0.18 minus 0.08. That is the answer. 86.13. 86.13. What happened to our answer? 8.0. How is it? Where is it? See here, Amit, starting from here, 0. How much is it? 3.48. Multiplied by 1 plus 0.58 to the power 6. That was the D6. Right? Tell me D1 value first. These are present values. So starting from 3.39 to 2.98 means those are present values. Before moving to that one, tell me the dividend value there. D1, how much is it? How much is it? D1 3.48 multiplied by 1 plus growth rate to the power 1. How much is it? 4 point 4.0. D2. D2. You tell me D2. How can we calculate D2? This is the way of calculating D2. See here, me. 3.48 multiplied by 1 plus growth rate to the power 2. Tell me the answer. 4.6. D3. 5.2. D4. 6.08. 5. 6.9. 6.9. 6. 8.04. 8.04. That's 0.15. What else? 0.15 or 0.5. That is the answer. Right? Why we are dividing? What I have done here, I have divided by. One format is 1.8 to the power 1. Right? To the power 1.8 to the power 4. Right? Now, okay. First value 50. For boys. D6. 8.48 to the power 1.15 to the 6. Yeah. This is the back. And then one D6 will be an yeah, plus 0.1. Yeah. Divided by 7. This is our golden. तुम दोगे मुस्लिम में कितना और 86.94 should be multiplied by 1 over 1 plus r. Okay. So you receive this answer as 86 and then 86.4 or something multiplied by 1 over 1 plus r to the power 6 means that gives us 32.11, right? So then real value of this share. So, yeah. So then value B equals 19.11 plus 32, that is 51.1 here out 51 and 50. Okay. Any question? No. Then you can have your break and come home tea.
Diluted in
Inside. So we'll next to discuss growth rate calculation. So far we have identified growth rate, right? So now we'll identify how can we identify this growth rate, right? So how the way of identifying the growth rate is ROE multiplied by retention ratio. Have you heard this word before? ROE, retention ratio and all the things? Have you? No, right? So ROE means return on earnings. ROE means return on earnings, right? If the investor is a shareholder, right? If the particular person become a shareholder, and then what will be the return of that particular shareholders? Return is their profit. Which profit? Profit after tax. So we call that one as a net income, right? So then just imagine there are 100 shareholders. Then how can we identify the ROE? Shareholders net income divided by the shareholders equity. Shareholders equity means which shares we have to consider? Which shares? Ordinary shares, not the preference shares. Then earning per share, EPS. EPS means if an investor invests in a particular company for one share, what would be the return? Right? What would be the return? So then if you are an investor, if you are an ordinary shareholder and then invest in a company, so you have purchased 100 shares. Particular company including 1,000 shares. Their net profit is for this year 1 million. Right? How can we identify per share earning 1 million, that is our net income, divided by 1,000 shares, total shares. What would be then the earning per share? 1 million divided by 1,000 means it is 100 rupees, right? 100 rupees or the 1,000, right? It is 1,000. Yeah, 1,000. Earning per share, what is it? Right? The capacity of a particular one share to earn some sort of a return reflected by the earnings per share. Next one. If a company, right? So these two are same. ROE, EPS and same. Only the difference is what? Only the difference is here we consider the value, right? Here we consider the value. Here we consider the number of outstanding ordinary shares. So then it is coming as a percentage and this is coming as a rupee value. Just imagine if you have invested a company, you have purchased the Sampath Bank share. How many shares you have purchased? You have purchased one share. Right? One share. So now, earning per share. Right? The earning per share is, for this one share, is 1 rupee. Right? 1 rupee. So if your earning per share is 1 rupee, they have if a company earning a 1 rupee, they have alternatives. Right? What are the alternatives they have? What they can do is they can distribute this profit, part of this 1 rupee as a dividend, right? They can distribute the earnings profit as a part of the dividend. To whom? To the existing shareholders. Because why? Because they are the party who gave us the funds to run this business income. Right, to run this business income, the ordinary shareholders provided us the fund. So then, as a return, we have to give something to them that is called as the dividend. When we are making a payment for this dividend, we call that ratio as what? Pay out ratio. Right? We are paying it from company to the outsiders, pay out. 1 rupee earned, and then payout is 60%. Right? Payout is 60%. So then how much they are going to segregate as a dividend, tell me, for a one share? That is 60 cents. 60 cents. What happened to the remaining one? Remaining is how much? Remaining is company earned 1 rupee share for a one share. We have segregate 60% to the existing shareholders. How much is remaining? 40 remaining. Right? 40 remaining. We call that one as 40%. That is our retention ratio. Retention ratio, how many cents? 40 cents. Right? So this is how the companies are segregating their earned profit. Earned profit can be segregated based on the retention ratio, and then the other one payout ratio. Payout and retention ratio both together should be equals to 100, or in cents it should be equals to 1. What is it says in singular? Company එකක් 1 රුපියලක් earn කරපුවා මේකෙන් භාගයක් මොකද කරන්නේ? Shareholders වලට distribute කරලා ඊටු භාගෙ company එක තියාගන්න. That is up to the company's finance manager. What sort of amount that they are going to distribute, as well as what sort of things that they are going to hold within the business. Okay. We can do this example, and then we can identify how can we arrive at this dividend growth rate. We can pass the message to your friends. Huh? Okay, read the question. The book value of the firm equity per share today is 100, and then return on equity is 10%, and then firm retention is 60, and then calculate the dividend growth rate. Okay. Look at here very carefully. Book value per share. Book value per share. Book value per share means what? The value of the share, recorded value. How much is it? 100 rupees. ROE. ROE is how much? ROE 10%. So then EPS would be definitely EPS, earning per share equals, we have 100 rupee per share. On that one, we are going to have the 10% as our earnings. How much is it? That is, for a one share, how much is the earning? 10%. Retention is 60. If particular one share earns 10 rupee, part of it is going to be retained, and then remaining is going to be distributed as a dividend. So then we call the retention ratio. Retention for the year. Retention for the year 1. How much is the retention? 10 multiplied by 60. That means 6 rupees. Distribution or dividend. Dividend for the year, how much is it? Dividend for the year 1, 10 multiplied by 40. That is 4 rupees. All these are for the first year, right? All these are for the first year. Then, second year, right? Second year. This is book value for the first year. Year number 1. Year number 2. Book value. Book value per share equals now previous year 100. Previous year 100. Now is that the same amount? Is that the same amount? No. Why this would not be coming the same value? Why this would not be coming the same value? Because last year we have a retention. Retention means it is again added to the normal capital. That is called as the retained earnings. Retained earnings. If you are preparing the financial statements, you know, right? After profit after tax, so then you have a dividend payment. Once after you reduce the dividend payment, all the things are going to be up to the equity, retained earnings. So that is what we are discussing about. Right? Retention means retained earning. Dividend means number of amount that we have share. Right? This is regarding the per share. Normally in the accounting, you are not considering the per share value. What you are doing is per share multiplied by the number of shares, and then total deduction is going to for the capital changes in capital equity. Yes, statement of changes in equity, or the sometimes you are deducting it from the at the latter part of the statement of financial statement of income as a dividend. Yes. Last year, book value 100. We have retained something. How much is retained per share? That is 6. Then now book value is how much? This year book value 106. From this 106, we are predicting ROE same, no ROE and EPS. So then EPS, we'll calculate EPS for the second year. How much is it? 106. Per share value is 106. Definitely we know we will receive 10% on this one. How much is earning now? 10.6. 10.6. Right? 10.6. And then calculate the retention now. Retention equals, we have earned 10.6. Out of that, we are going to we are going to retain 60. So then the value is 6.36. 6.36. Dividend for the second year, D. Dividend for the second year, 10.6 multiplied by 40%. How much is it? 4. Altogether, it should be 10.6. Now look at here. Last year dividend, right? This year dividend, 4.24. Right? This year dividend, 2.42. Last year dividend, last year dividend, Hello. Last year dividend, Hello, Nishan Hello. Last year dividend, very good. 4. I want to convert this one into percentage. It has been grown. It has been grown now. So then we have to identify the percentage divided by 4. What is the percentage? Percentage? Six. That is 6. The other way around, right? We'll calculate like this. Retention growth 3.36 minus 6 divided by 6. What is the retention growth? Retention growth? Yes, exactly. That also 6. You can see here, right? If retention ratios and then the EPS, ROE not changing, dividend. So this is dividend or this is dividend. This is retention. Dividend growth equals to retention ratio. We can just calculate the dividend growth by comparing the two numbers. But if you were not given these details and only if you were given these details, how can we identify the growth rate? So we don't need to do all the calculations to identify the dividend growth rate, which is similar to the retention ratio. Right? Forget about this one, dividend, and then look at the retention because dividend and retention is equal. So then, how can we identify this 6%? In identifying this 6%, you have to decide this is the cost, right? 6 becoming 3.66, 6.36. That is why it marked as a 6% growth rate. If it is 6 is increasing to 3.6, what are the two reasons for that? First one, what is it? Yes. Yes, because 60 retention we have. Retention is 1. Retention ratio. Is that only? No, right? Because retention is 60. Retention multiplied by 10.6. Right? Why this? You can see here. Last year, right? 6. That is the retention amount, retention ratio. That's one thing. Other than that one, we have what? If we have a ROE only, you can have a retention. If you do not have ROE, can you identify the earning per share? Some years there might be not earning per share. So then, if only the ROE is there, which is providing a base for the EPS, right? ROE. These are the two factors that are affecting to 6 becoming 6.36. So then, if you multiply retention ratio with the ROE also, you can have the growth rate. Now, method calculation circuit that ROE multiplied by retention give us the dividend growth rate. Actually, company's growth rate that is equal to the dividend growth rate. Then the answer for this question is dividend growth rate is 6%. Okay. Okay. Next task, calculating required rate of return if the using the constant model, but we are discussing this part entirely from the cost of capital lesson. So, Shakir. Don't worry, Shakir. So we are discussing the required rate of return under the cost of capital model. The next after the next lesson, anyway, we discuss the required rate of return. How can we calculate R by using the constant model? So we know under the constant model value can be calculated with the D1 divided by required rate of return, the difference between required rate of return and then the growth rate. If I want to identify the required rate of return where the other information were provided, how can we identify R equals DIV or D1 divided by value plus growth rate, right? But there are other ways on calculating this. Or we have another name for this one. This is called as the KE also, right? KE, cost of equity, right? Other than the main valuation lesson, so these are the some of the sub branches of the valuation lesson, identifying R and then the identifying growth rate. I will do the example number 6. Very simple. But combining both R calculation as well as growth rate calculation. In this question, you have to first calculate the growth rate and then go to the R calculation. Growth rate is 9%. Yes. Okay, good. Percent. Growth rate is 9%. How can we calculate growth rate? ROE is how much? Next battle. What is the ROE? 22%. ROE? ROE is 10%. Multiplied by retention. How much is retention? 75%. That means 0.12 multiplied by 0.75. That is the answer. 9%. Okay. Using that 9%, right? You also given the value of the firm also. Right? Value of the share value is how much? 40. Right? 40 is one side, and then you have to find what? You have to find just the R. Right? R. You have to find the R. So then what is the R? 20. Okay, we'll calculate. Now we have found the growth rate now. Growth rate, that how much is it? 9%. Then we know value B equals dividend divided by R minus C. If you take the, if you take the R, then value divided by dividend in, B divided by value plus growth rate. Is that the formula? Yes. How can we? Dividend? Which year? First year dividend. What's the dividend for the first year? Just paid dividend is how much? 5%. You have to identify which dividend. First year dividend 5 multiplied by 1 plus growth rate 0.09 divided by 40 plus 0.09. 21.5. That means 22. Shaki. They have a good friend, you know. Go quiet. Subscribe. Okay. Back. Let's start. Price multiple sets. Second method is multiples. Before moving to that one, we'll draw the mind map for the ordinary share. We had two methods. Go to the first lecture, first page of your the mind map. We'll mark the mind map, right? So what we have discussed, DDM consider two factors. What these two factors are? First one, holding period. Second one, growth rate. Holding period, we had two branches. Single holding period. Single holding period. How can we value? Dividend first year divided by 1 plus r to the power 1 plus P1 divided by 1 plus r to the power 1. Single holding period that. And then multiple holding period. Multiple holding period. You can look at your note and write down the formula. If it is so, value B equals, starting from T equals 1 to the summation to the nth year, dividends in respective years multiplied by 1 plus 1 plus dividends into 1 plus r to the power t. Dividend in respective years and then plus Pn divided by 1 plus r to the power n. Then growth rate. By considering growth rate, we had three branches. Zero growth. What's the formula? If it is zero growth, dividend divided by r. Constant value. Constant growth. Dividend in first year divided by R and G, and then differential growth. Differential growth. How can we take? Starting from T equals 1 to the nth year, have to consider D multiplied by 1 plus growth rate 1. And then converting into the present context, R divided into T. Right? And then plus, it should be identifying dn plus growth rate 2 and then difference between r minus growth rate 2 multiplied by 1 over 1 plus r to the power n. Other than these two branches, we have discussed calculation of growth rates. Two branches, growth rate. That is G. How can be ROE multiplied by retention ratio. And then other one, R O, mark it as KE. KE equals OR equals value dividend divided by value plus growth rate. So these are the things that we have discussed. Please clear the items as well as the formulas before moving to the price multiplications. Most of the, if you have downloaded the formula sheet to the exam, most of the formulas, the base formulas were given at the examination, right? Therefore, just try to remember what you have not given at the formula sheet. It also has been uploaded to your LMS. You can download and have a printout. Okay, no, Dora. Can you believe in that? Put in notes the theory carbon balance. For the peg level, clear. You can turn to your notes and then write down formulas. Then take down the heading price multiples.
Oh, yes.
Okay. So we had two models, but those two models are first one DDM and the other one, what is it? What is it? Price multiples. DDM considered what? Growth rate and then the holding period as well as time value of money. But price multiples, very simple, right? It's a method that how can we that's a method where the value of the share is obtained based on the comparables. That means by looking at the financial metrics that has been already calculated by the firm, we are just going to predict what would be the price, right? What would be the price? So therefore, so this is actually by looking at industry value, by looking at financial metrics, we are going to calculate the share value, not the time value of money concepts involved here, not the growth rate calculation, nothing calculated here based on the historical values that the company has calculated. We are just going to predict about the firm market values, right? So we have three comparables actually. So the companies are calculating price to earning ratio, companies are calculating price to book value ratio, and then companies are calculating price to sales ratio. These are the ratios calculated by the firms. If you go to the statement of annual, if you go to the annual reports, you can identify within first 10-20 pages, you can identify the financial highlights are there. In the financial highlights, there are some ratios, right? In that ratios, definitely you can identify price to earning as well as price to book value, and then price to sales ratio are mentioned. As a financial analysis based on the historical value calculated by the firm, based on this historical value calculated by the firms, we are going to predict about the market value of the share. We call this one as, right? We have already price to earning ratio. By looking at that one, we are going to calculate the market price of a share, where we call it as a price to earning multiple. One by one, we'll calculate. We just focused on the two ratios. First one, price to earnings multiple. We all know price to earnings ratio. How can we calculate price to earning ratio? Price of a share divided by EPS, earning per share, right? So then price to book value price to earnings multiple reflect what? For a one particular earning per share, what would be the market price of a share? That compares price to earning ratio compares what would be the market price and then what would be the earning per share. It compares these two metrics. Accordingly, it identified for a one particular EPS, what would be the market price of a share. This has been already calculated by firm, right? This is already calculated by firm. If you know this one, it is very easy to capture the share price. This is the way that we are going to identify the share prices in price multiple models. Know any yards, know any time values, just look at this ratio and then earning per share and then identify what would be the share price. Very easy. Clear? We'll then go to the question number 8. Read it first. The companies, they are common share trading at 80 rupees, right? If you go to the market, you have to obtain it at 80 rupees. And then historical average PE, price to earning multiple, right? Historical average PE, already calculated PE, we know it. How much? 10 rupees or 10 times. Actually, it is 10 times. Outstanding number of common shares. Ordinary shares. 3 million shares we have. Last year, we have reported earning 22.5 million. Profit for earning 22.5 million. So then in identifying what it does actually, estimate the value of a common share. The value of the common share. We know PE multiple equals value of a share divided by EPS. How can we obtain the EPS? In growth rate calculation, we identify EPS equal EPS means earning per share. Earning per share means we have total earnings. It should be divided by number of ordinary shares. Right? Ordinary shares. We don't know the value of the share. That's what we are going to find. Total earnings, that is 22.5 million for the last year, divided by 3 million shares. 3 million, 22.5 million. So then you can identify the EPS. Already we have historical PE, that is 10 times. 10 times. It is very easy then to calculate the X. X means value of the share. Value of the share equals is 8. It's 75. 75. X equals 75. The value is 75 rupees. But if you go to the market, it is currently traded at 80. Do we need to purchase or not to purchase? Not to purchase. Why? Even the real worth is 75. It is trading at 80, which is overpriced at the market. Don't buy. Right? Not to buy. That. Next multiple, right? So in the historical financial figures, already the financial accountant calculate or compares what would be the value of the shares or what would be the equity value, and then in line with that, what would be the book value per share, right? Book value per share. How can we calculate book value per share? Book value per share. Book value divided by number of ordinary shares. How can we find the book value? Book value? Yes. Book value. Net worth. Then the net worth of the business divided by the number of ordinary shares. If you know the book value per share, if you know the historical calculated PBV, it is easy to calculate the stock price per share. That is what we are going to study here. Okay. Example number 9. Try to do it. Net worth, right? Net worth means book value of the equity, net worth of the business. From the total assets, you are going to deduct the liabilities and it shows the net worth of the equity. That is called as book value of the equity.
Past average 9. No? Yes. Okay.
We know how much is total worth or the book value of equity is 18 million. Okay. PBV is 9 times. Right? 9 times. And then book value per equity for the most financial statement of the company is 18 million. And then number of outstanding shares 1.5 million. And then currently it is trading at 100. Alright. So then price to book value multiple equals share value divided by book value per share. We don't know SB, book value, the share value. So then if you know the PBV, sorry, PBM, you can multiply it by book value per share. Book value per share. Taking into the here, we know PBM, right? PBV, book price to book value multiple, it is 9 times. 9 times. Multiplied by book value per share. We know total book value of the equity is 18 million. Number of ordinary shares, that is 1.5 million. Right? 1.5 million. So then your share price, share value equals how much? 108. 108. But if you go to the market, you have to give only 100. But the real worth, Patu, real worth is 108. But you can purchase it for 100. Is that worthwhile to purchase? Is that worthwhile to purchase? Yes. Why? Even the worth is 108, you can purchase it for 100. So then it is underpriced at the market and then purchase this share. Very easy methods. Okay. Is that okay? That's it. Right. We are discussing two metrics and the sales. Which approach is best? Is that DDM or the PE? Definitely it should be PE, right? That's very easy, no? From 9, no. That's up to the companies. Which one they are going to select for the valuation must know. But normally they are taking the DDM since it is identify the growth rate and then the holding period, which are actually the real value, real components that we have to analyze in valuation rather than by looking at the comparables. Clear? Right. Yeah, that's regarding the valuation lesson. You all can complete this one. TDM and then price multiples, the other branch, price multiples. We have two multiples. PE and then PBD. PE share value divided by EPS and then share value divided by PB. So we'll start your quiz at 3. Now it is already, you can complete this one and then you can start your quiz then. 3, 5. Want to go home now? You are in a hurry now? Is that open? No, you have to give several places and start your quiz. And then you have to do the workings on a separate paper also. Right? It need to be given to me. I need it. Yeah, you can use your notes. But you have to go to several places. You have to come to several places and start it. Starting 3, 5. Oh, yeah. The working paper should be handed over to me. And please write down your index number as well as the registration number with name with initials. Likewise. One of you can stand up and go to the several places. I'm not going to ask any questions from you regarding your quiz, so then you can do it by your own. Take your time. You have 20 minutes, right? 20 minutes and 10 questions. For one question, 2 minutes. Okay? Yeah, you can start it from 2, 3, 5. Check whether it is available. Quiz 1. Take a separate paper and you have to write down the answers as well as workings in a separate paper. I need the way of doing it. You can come. So that you can stand up and come. What's your name? All right. Online students. You have to come to the lecture. Right? So there are 1, 2, 3, 4 students. Only 3 students. So then students you have to participate physically for the quiz. So then the director, Rashmini and then Marshani, you can come to such lectures as well as so then you give the quiz for you all. Right? Don't attempt the quiz via online hall. I will give the time as well as give the time slot as well as enough the space and all the things you have to participate for the lecture and then do the quiz. Physical participation is compulsory for the quiz. If there are no any extreme cases.
Manish,
Manish,
EFC,
Director.
please overseas.
Director, can you hear me? Okay. Overseas student, Director, can you respond please? Director can attempt, right? Since you are an overseas student, you can attempt for the quiz, but you have to hand over me the workings. I will open a link at the LMS, so then you can submit your working to the LMS. You also have to upload your quiz workings to the LMS. I will open a portal for that. Is it available? Quiz is available. Good.